I think if you look at the sources of returns for equity markets is dividends, earnings growth, and then the multiple that you're willing to pay for those future earnings, right? So we've seen the multiple being affected because of the uncertainty around tariffs. The question is, are the actual earnings going to be affected if this continues? So far, what we have seen is now seeping into the conversation. So for instance, in earnings season, 40% of companies that have reported during the earnings calls have mentioned the word tariff, right? Versus last quarter, it was only 25%. So it is starting to become a topic of discussion. Having said that, there's companies, for instance, like Caterpillar, that mentioned that yes, input costs have gone up, but they've been able to pass it on to their clients, and therefore earnings have not been affected. So I think it's too early to say this is really bad for earnings. It is already fair to say it is bad for multiples because it's bringing in uncertainty.
We're seeing compression, right?
Okay. So that's how I would put it.
James Liu, what do you think? And let me add another question. The sell-off that we've seen in FANG, people are going to open up the paper, if they still subscribe, and see that the FANG index is now in correction territory. What does that say about the broader market? Should we be worried that if that's fallen apart, so is the rest of the market?
Right. So from a broader market perspective, this is clearly an earnings-driven market that we're in right now. 23% earnings growth for 2018. That's a spectacular number. The challenge from here on out, and where it relates to areas like FANG, is that a lot of that is already priced in. You look at the market, we're pretty much at fair value, 16.5 PE. Now, if we got back to the heights of valuations that we saw last year, maybe we see a bump there. But there's a lot of uncertainty and volatility out there, especially around macroeconomic risk. Over time, that 23% number should come down as well. So over the long run, maybe we only get 10%. So basically, what we think is that the market is fairly valued right now. Things like FANG were somewhat inevitable because they had run up so far. And so we like the market, but we wouldn't overinvest in the market right now. We would be somewhat defensive, especially given where we are late in the cycle.